Stand up for righteousness. Stand up for justice. Stand up for truth.
I truly believe that thoughts are the greatest vehicle to change.
We do not care whether the cat is black or white, as long as it can catch mice.
We choose to go to the moon in this decade and do the other things, not because they are easy, but because they are hard.
Victory in spite of all terror. Victory however long and hard the road may be.
To those waiting with bated breath for that favorite media catchphrase, the U-turn, I have only one thing to say. U-turn if you want to. The ladies not for turning.
The only limit to our realisation of tomorrow will be our doubts of today, is a quote from the American statesman and leader, the 32nd President of the United States, Franklin D. Roosevelt. I thought this was an appropriate quote for our guest today, someone who's playing a key role in the technology startup ecosystem, helping unlock the possibilities of tomorrow for today's founders. Our guest today is Matt Allen, co-founder and co-chief executive officer of Tractor Ventures, a non-bank lender focused on technology startups. Before this, Matt was part of the venture capital and startup team at Amazon Web Services and previously held chief technology officer roles. He's also chairman of AI-driven experience platform QSIC, co-founder of Side Stage Ventures, and a member of the investment committee of the Alice Anderson Fund, a $10 million co-investment fund developed by the Victorian government to invest into women-led startups. Hello and welcome to another episode of No Limitations, a show where we speak to elite, world-class performing men and women and unlock the secrets and influences that have shaped their destinies and that you could apply to your own life. For our first-time listeners from all over the world, please don't forget to follow on your preferred podcast platform and share with your friends and colleagues. And for our listeners in India, Japan, and Germany, a big hello. I am your host, Greg Robinson, managing partner of Blenheim Partners, board and executive search firm. Unfazed by the appeal of launching rockets, Matt and the team at Tractor Ventures focus on consistency, reliability, and giving founders the optionality to scale. He also touches on the excitement that comes with the unknown when it comes to investing in game-changing technologies, the evolution of the role of founders, and the type of founders that make great CEOs. So sit back and enjoy Rolling the Dice. Matt, welcome to the show.
Thanks for having me. I'm excited to be here.
One of your mantras has been, don't screw the founder by taking too much equity.
Yep.
Pretty rich coming from a VC sort of type background, isn't it?
It really is. The thing about that, especially when talking to technology founders who, a lot of them are aspiring to grow a very big business, it's usually going to be quite capital intensive along the way, which means they're going to have to sell parts of their company to capitalize it so they can continue to grow.
Mm-hmm.
The challenge you've got, especially as an early stage investor, when you're writing that very first check in where there isn't a lot to go on, you might be tempted to come in and buy a big chunk of the company, half their company.
Mm-hmm.
Right now, the challenge and the balance we've got with those two things is most entrepreneurs and founders don't want to feel like they're working for anyone else. That's why they're doing it for themselves.
Absolutely.
So on the assumption that the very best growing tech companies that go down that externally funded route with other people will need to probably continue to have to raise for a long time because they're not necessarily in that cash flow positive, profitable state, especially once you're on the VC bandwagon.
Yep.
The likelihood of you having to sell, 10 to 20 to 25% of your company every time you go to market, could be every couple of years, means the founder ends up with a tiny bit of equity. Hopefully it's of a very valuable company. However, that first check-in can make or break them. And the reason being is the next check that comes in behind them want to know that, the founder's going to have enough equity to stay motivated and focused and not feeling like they're working for, just their shareholders and that their diminishing part of this pie is going to be valuable in the long run. So as a person who writes the first check into these businesses, you can make it really easy or really hard down the line. And it's a tension, right? It's a balance between, I don't want to own half of 1% of a tiny brand new company, I need to own enough to feel like I'm getting good value for my equity. But I want the founder to feel like that they're all in, and that when they look at that share register and that cap table and they see their percentage and they feel like they're going to be, a millionaire or a billionaire at the end of it, right? They got to feel that way.
So when you're writing the checks, are you going for the full ride all the way through, or do you pull out at some point?
So interesting enough, a little bit of both. When we write checks into companies, it's called primary capital. All the money goes onto the balance sheet.
Yep.
The company gets to use that capital to grow. As a company scales, especially when they're scaling well and they're growing well, and there's lots of investors who want to get onto that cap table, the likelihood of being able to have a secondary was sell some of my old shares to the new person, because all they really want is a percentage of the company, and they don't necessarily always thinking, all my money needs to go into growing this company, especially when they're a bit further down the track. So personally, secondaries, which is that for me, has been really meaningful for my angel investing career. The reason being is I'm not a super cashed up guy. So when the opportunity takes the money back off that I'd put in, means I can go and make 5 or 6 more investments. So there's been times when the returns via that secondary transaction, which is not, the company hasn't listed, the company hasn't been acquired, it's just a new funding round where some of those people are happy to buy some of the old shareholders out. Yeah. I usually don't sell everything. I usually sell a portion of it rather than some of it, and allows me to continue to be an early stage, as we call, angel investor. And I've got a saying that says, if you haven't made an angel investment for 6 months, you got to give your badge back, right? Like it's a thing you've got to continually do. Otherwise, you forget how to do it, and it's never great.
Okay, so for how long and how many checks have you written?
So this is very much a journey with April, my wife and I, because we basically started investing out of our self-managed super that we set up specifically for tech investing.
And you're still talking to each other.
Yeah, still talking to each other 25 years on. And then out of the mortgage, conventional wisdom would say, don't borrow to invest in tech companies. And I would strongly recommend it. However, we've always just had a big offset sitting there, which is obviously when the cash rate's quite low, putting it over there and hoping that you're going to get a decent IRR, which is obviously in a fairly illiquid asset. You just got to, that's just the balance we've always done. So it's taken us about 10 years to get to 50. And there was 50, a steady state for the first 5 years. And then I actually had some of those secondaries. There was a point where there was quite a significant amount I was able to pull out of a very fast growing company, which allowed me to do a whole bunch more at once in the last probably 3 or 4 years.
So I'm sure there's a little banner that says, don't try this at home, must pop up sometime. Right. Okay. But you have tried it at home. What are you basing it on? So
the first half of my career, I was a software developer. So I'm old. So I've been building software for the web mostly since the web came out in the mid-90s. Mm-hmm. So I've been self-taught because you couldn't learn at university. You couldn't learn by books because there was none back in the day. When the first web browser came out, and it's like the only way you can learn is to copy and paste your way to try and understand it.
Yes.
So being a technologist for the first half of my career allowed me to understand technology and sort of ride that wave through the internet, through the dot-com boom, pop out the other side, keep going. My first technology startup I started in 1999, right before the boom sort of busted. But that allowed me to do a couple of things. It allowed me to understand how the technology works. A bunch of my mates are also technologists, but as it turns out over time, I'm more interested in business than I am in technology. But having a deep understanding of how it all works gave me a little bit of an edge. And it also allowed my other mates who were technologists who had an idea and wanted to go start something to come and talk to me first, because I was like the techie guy that had more of spoke about business all the time and spoke about and transitioned away from coding. Yep. Into after that I became a technical recruiter. So I ran a recruiting company.
I knew a good guy somewhere along the lines. I thought you had some good qualities there.
Purely for software developers. And you'll know this, recruiting is a sales job. Usually it's by people that are fairly au fait with sales and people. Our shtick was we were all devs. So we were coming in from a position of we understand the problem you're trying to solve, from a software level. We can nerd out with people, whether they be the customer being the CTO or the client being the software developer, and really kind of understand and get the nuance of that right, where there's a lot of acronyms, there's a lot of things that are compatible and incompatible with each other, and being able to sort of have that conversation with both sides of that transaction and get it right, rather than just sort of, machine gunning a bunch of resumes and hoping one ticks the box was our stick. So by the time I turned into a recruiter, my software developer mates who were starting to start companies would come to me and say, you're a business guy. Like, what happens next? How do we do this thing? And I'd be like, I can rally some troops and we can put some money into your company and you can quit your job and then you can go focus on this full time. And that happened multiple times.
Big bets they're placing, aren't they?
Yeah, I mean, they are. And it's all risky. And the same thing I say to anyone who's doing these early stage investing is you've got to kind of forget about the money. It's gone. Like, it's just sort of popped out of your head. It's probably in a spreadsheet somewhere. But in reality, it's not like you're checking your stock portfolio and watch it go up and down every day. It's like, I really like these people. I really think they're solving a problem that they deeply understand. And this is going to take years and years and years and years. And, I can't ring them up and ask for my money back. It is the ultimate illiquid asset. Like, the likelihood of getting your money out on your whim or your timeline is probably zero.
Okay, so then what are you looking at when someone comes with a proposition to you?
To be clear, I don't do a lot of personal angel investing anymore. I've sort of got a few other big focuses, but a lot of the time, for me, it's lived experience. So, when they talk about the problem they're trying to solve, and they're like, this problem has haunted me through my whole career, and it only now can I go off and solve it. I feel like I've got the solution. I'm building this solution, to go off and solve this problem. So, lived experience versus observed experience.
Yes. And
our portfolio of founders actually has a bias towards older founders because they've been there and done that, right? So, the stereotype is you're back the guy who pulled out of Harvard and solved a problem when they were 21 and created, the next social network. But when you think about the world in general, a lot of software is business-to-business software.
Yep.
They need to really understand their customer. They probably have been their customer quite often, or been the person who would be a customer.
Yes.
And you don't get that overnight, right? You can't dive in deep into that unless you have that, experience over time, which allows you to understand the problem and then start forming the solution with it. So I'm looking for people that really get that problem, can demonstrate that the solution they're building is more variable than the problem. The problem's pretty constant, and the solution, it's not necessarily the one they've got sitting right in front of them right now. It's a version of something it might be, and they're more attached to solving the problem than the current solution, because the solution moves around, right? We all use software that changes features and stuff like that. So some people are very this is the thing, and they're less inclined to be able to listen to the customers and really focus on that problem.
I guess the question is, do they know how to commercialize it? Do they know which platforms, avenues? As you say, right, they're the technology guys, and they love it, and it's a passion, and they're bringing you in. But what is their sort of level of commercial sort of reasoning?
It's really interesting because that applies specifically to what we do now, where we do financing for growing companies. So the way I describe it is, quite often initially there's a problem, and the founder is wrapping a solution around that problem, and then they're wrapping a business around that solution. And then eventually the nuance in there is they're figuring out how the right way to capitalize that business to implement that solution to solve that problem in that order, right? So the first thing is like, this problem is really pissing me off.
Yes.
And then I think I've got a way to solve it. And they start solving it, tinkering and building things, and they might show it to some people who start using it, and they might start billing them for it. But, the business around the solution, around the problem is really important. And as you've touched on, they may be product domain experts or problem domain experts even, and may not have a business bone in their body. And that can be challenging. There's been a few founders I've spoke to that, that I've even invested in. The companies are now shut down because they were so nervous to turn the revenue on and start charging for it. And it's not quite ready, and we're not there yet. And I'm like, well, this money we've put in your bank account a year ago is not going to last forever, right? And at some point in time, we've got to wrap that business model around the solution, around the problem. And, you've got to do that. And obviously, when you're speaking about being a technology venture-backed company, a lot of the time the VCs will fund growth that may not have the business model sorted out.
Yes.
They may be looking for the right business model. It could be a recurring business model or whatever the case may be. But, for me, quite often I do want to have that conversation with them pretty early and understand exactly how they're going to make some money in this thing.
Okay. So during this period of time, you've also spent time with Amazon, is that right?
Yeah, that's right. Amazon Web Services. Yep, the cloud.
So what was that all about in the sense of what did you take from it?
Yeah, so a good friend of mine was running the startup and venture capital team here in Australia, which was barely a team. It was 2 people when I got there. Part of an 80-person team globally, so it's around the whole world.
Okay.
And it was really there's 2 things I was trying to solve for. Was one, use the skills I had with investing and so forth to try and see whether they were commercially useful. And second of all, see whether or not I was employable. So I've been a self-employed for a long time.
Okay.
I'm like, I wonder if I could actually do a job. So the answer was I could do that job at that particular, role in the company. It was fascinating. It was a business development role, so it wasn't a sales role. I didn't have any of those kind of quotas.
Yep.
And the brief to me was like, you seem to be, interested in tech founders. You've obviously got this growing portfolio of founders. Come and help us talk to them about how the cloud can work for them better. Amazon wasn't investing money, but we had lots of cloud credits. So, I could allocate up to $100,000 real money into their bank account, which would drop their bill down to zero for as long as it took, right? So, so
smart.
Picking up the phone and saying, hey, it's Matt from AWS, can we have a chat? The first of all, they're like, where are you? I'm like, well, I'm in 8 Exhibition Street in Melbourne. They're like, really? I'm like, yeah, that's our office. And you're here in Australia? That was confusing to some people. And then it was like, sure, come around, tell me what you do. So my job was to make sure that I found the best founders, that they were really using the cloud to the best ability, and then help them grow better businesses. So my job was to help them get them onto stages at our conferences and talk to lots of customers and connect the dots. I was just a big dot connector, which, having been a previous recruiter, as you know, our job is to sort of hold a lot of context of a lot of people doing and connect the right dots at the right time. So it was a bit of a continuation of that. But it was actually the spot where I met so many founders and saw the real problem that we're solving at my current company called Tractor Ventures. And the problem that we saw was I used to get these spreadsheets with little charts in them for every company about their billing data. So obviously we couldn't see their actual data, but you could see how much they were paying for the Amazon services.
Yes.
And some of them were growing like a weed, right? They just sort of up and to the right at a rapid clip.
Yep.
And I'd click on the link and go have a look at their URL and you're like, who are these people? And you call them up and they're like a couple of blokes out at Ringwood, in a garage somewhere going, yeah, we've built this thing. And we're like, well, how did you fund this thing? They're like, what do you mean? We charge our customers. We've solved the problem. We saw the problem. We built a solution. We turn on the billing. Next thing you know, we're doing $1 million in revenue. And they're a small team, efficient team. And my question is, well, how do you grow from here? Like, how do you capitalize your business?
Yep.
And, the traditional way was, do you use venture capital? And venture capital is highly focused on scalable tech businesses.
Yes.
And, it's a really interesting funding mechanism, which is they want a business that can return 100 to 1,000 times their money. So the venture funds here in Australia run anywhere between a $50 million fund or a $30 million fund and $1 billion fund.
Mm-hmm.
And every time they write a check, they want that one check to return the whole amount of money. Even that check might only be a tiny fraction of their fund because they work on the theory that we're going to make a lot of bets. 80% of them are going to go to zero. The company is going to die, and that's okay.
So it's 80%. That is roughly the numbers, is it?
So, yeah, and of those 20%, a small percentage will be a massive outlier and return 1,000 times their money and return the entire fund multiple times over. A small handful will be, in that 10 to 100x, and then the rest are sort of nothing. They don't really think about it. So that's called portfolio theory, right? We're going to make a lot of bets. We know that the vast majority are going to go to zero.
Yes.
But we want some of them to be the next Canva or the next Dropbox or these, these huge companies that generally go off to list on the NASDAQ is usually the way, the grand plans. They're probably acquired along the way, a lot of them, but they need to be big and to be scalable. So the challenge that I saw when I was at Amazon was speaking to these founders was one of two things. Either their business would never be that big, even though it was a scalable technology business. It was usually selling to companies around the world. It's just like, you're not going to be that big. Or that the founders were like, I'm not willing, because when you take venture capital, you got to go fast. We call it the rockets, and this is what we call Tractor. So VCs, they fuel up the rockets, they're rocket fuel, right? And rockets are very exciting. They've got a really hard job. They're really hard to land. And they blow up pretty often, right? Like that's the definition of a rocket, right? So if you're going to take the VC money, that's rocket fuel. Rocket fuel is for big missions trying to land on the moon or go to Mars.
Right.
My analogy was we'll let the VCs do the rockets and we're going to do the tractors. The tractors are more consistent and reliable. They create really important, functionality for their users, but they're probably not as exciting as the next Canva or whatever, right? They're just sort of going about their business and helping their customers do better work. So the challenge with some of these founders was we'd love to bring more capital into our business so we can grow faster.
Right.
But I don't think I'm ever going to go as fast as a rocket. In fact, I don't want to build a rocket. I'm really happy to be a nice, consistent tractor. I'm happy with 50 or 100% year-on-year growth, not 2 or 3 or 400% year-on-year growth. The reason is to grow that fast, you take a lot of capital, you hire a lot of people, it's a bit of a shit show, the wheels fall off, and that's just what you're signing up for.
Yep.
And the tractors quite often are, they're living within their own means. They're sort of, they hire people behind their revenue, so they're not, they don't have to get too far ahead of their skis and capitalize the business very heavily and then invest it all and hope the revenue catches up.
Yep.
So we built Tractor Ventures, and Tractor, instead of buying shares or buying equity in these businesses and hoping for 100x return, we use revenue, their recurring revenue, because they've got these customers that pay every month, as an asset. We take a opinion and a position on it, and we lend against it. So they're able to bring forward some of their revenue.
So this is the unique play here?
Yeah, this is the unique play. So we do revenue-based financing. So we believe that the asset that these companies have, which are all non-tangible businesses, so they're all software businesses mostly. Some of them have some hardware attached to it, but the majority of the value they're creating is with intellectual property and software. So they're non-tangible. And the problem at a macro level is if you go and start a hairdresser or a plumbing business,
yep,
a bank will finance the fit out of your hairdresser. If you go and say, I wanted to create a hairdresser in Toorak, they've got all the stats on what hairdressers in Toorak do, and they'll lend you the money, they'll finance it up, and you'll pay it off over time. And if you want to be a plumber, they'll lend you asset finance your truck and whatever. You go to a bank and say, hey, listen, I've written a bit of software back here that I charge $9.95 or $50 a month or whatever the case may be. The bank says, cool, I don't understand that. Like, I can't touch it. I can't sell it. I can't sell that truck if you don't make the payment. How does it work?
Yep.
So it's very difficult to get, it's easy enough to get equity, to sell shares to people that want a big, big return.
Yep.
It's difficult to sell shares to people if you can't promise a big, big return. And it's difficult to borrow money from anyone because it's a non-tangible asset business that people don't understand. The banks are traditionally unsecured business lending in Australia is a weird spot to live in. There aren't very many, the banks don't do it very well. A lot of the banks will lend you some money as long as you secure it against everything, your house, your dog, your jet ski, your kids, whatever. But a lot of founders building technology companies aren't willing to do that, right? They're like, hang on a minute, like, this is a good business. I don't think I should do that. So there's obviously the process of that. So we built Tractor Ventures to solve that exact problem, which is, how do you look into a technology business, understand the quality of their revenue,
yep,
and then take a position on it and lend them some money, and they'll pay it back over the next 1-2 years. And the way we do that is we actually hook deeply into their platform. So we hook into Xero, and we hook into their billing platforms and everything. We know exactly what's going on in these businesses.
So hook means penetrate, does it?
Hook means we've written software that connects to their software. So they connect up their accounting platforms into our software, their billing platform. So we know what's going on a daily basis. And the way they pay us back is via a top-line revenue share. So we'll negotiate that you're going to share 7% of your revenue with us until you pay this principal interest back. We think it's going to take a couple of years. If you grow faster, it will come back to us a little bit quicker. If you grow slower than expected, it'll come back a bit longer. And that's the risk we take. We know exactly what our returns are going to be. We don't know how long it's going to take. So to do that, we need to be connected into their platforms to know exactly what the cash flow and the heartbeat of this business is, so that we can pull the payment out every month. And it varies. So it's a fixed percentage, but obviously a variable amount, because not every business bills the same amount every month. That hopefully goes up and to the right in general. But there's seasonality. Sometimes it goes down, sometimes it goes up, and that's just how our business works. So we're a non-bank lender. We focus heavily on tech companies, and at the moment we're 2 years old. We've done 90 loans over 2 years, with the majority of those being in the last 9 months. So we've quadrupled the business last year. And it's really fascinating being a non-bank lender in this space where very few people play.
Talk us through the landscape, Matt. What's actually out there? Like, what is knocking at the door?
There's a lot. So we think about things as an asset class. So the asset class that we talk to are companies that are technology-based. So they have the ability to scale.
Yep.
We don't lend to services companies where they're constrained by bums on seats. We don't lend to offline companies like, plumbers and hairdressers. It's not what we do. You got your Prospers and your Mullers and stuff like that. We do companies that have the ability to scale, either locally or globally, but they're not risky enough for venture capital, but they're too risky for banks. And when you think about that as an asset class, it's a bit of a broad church, because there's a lot of software that does some pretty weird things out there for a very particular purpose that is probably doing millions of dollars a year in revenue. And if they had some extra capital that came into it, they could grow faster. but they're not willing to sacrifice this nice, consistently growing software business to put venture capital in it that forces them to grow even really, really quickly, which they don't want to do because it destabilizes their business.
Gotcha.
So that's what we really focus on. We do fund some hardware as well. So a lot of these businesses that are building hardware products or Internet of Things products or whatever the case may be, they get a big order. They've then got to go off and build, manufacture, and test these things before it's out in the field and generating revenue. We can take that risk off balance sheet and we can fund that as well, which is fascinating again, because that requires us to get in and understand how the business works. We understand when the cash moves in, when the cash moves out, the margins they can afford, so on and so forth. And a lot of these businesses are great because if it's software or even hardware, they run at huge margins. They're not thin margin games. They're usually thick margin games to the tune of sometimes 85, 90% margin on software. So there's a lot of really interesting businesses back there who are looking for ways to inject some capital in their business to affect their top line growth, and then they're happy to actually use us to do that.
So where are you seeing the actual growth in software? Which particular elements of it?
I'm not going to be able to rattle them all off, but we basically segment into 6 types of segments. And it's funny, you think about a normal lender, it might be hairdressers, and then there might be a geographical location, and that's sort of your segment is like hairdressers in Toorak or plumbers in Manly. And they can tell you all about plumbers in Manly because they've got a bunch of data. So what we're building also is this massive amount of data but the segmentation is usually the way they sell. So is it recurring revenue? Is it once-off revenue? And then who their customer is. So are you enterprise sales on a recurring? Are you enterprise sales on a contract? Do you sell to consumers, SME? So we segment them differently. Enterprise sales is a really interesting one, which is, you've got these big whales of customers quite often the time. They're slow moving, and the sales funnel can look really, really, really exciting, but you've also got to sort of deliver on them at the same time. Mm-hmm. So, to be able to sort of grab some of that revenue that's about to happen, pull it forwards, deploy it now, and accelerate that growth, that's really interesting. A lot of the things where it's sort of that inventory advance where, your sales team wants to sign a huge purchase order, but you don't actually have the capital available to scale up the manufacturing side of your business to actually deliver it. In fact, if we sign this and delivered it, the cash flow gap would be, would bankrupt the business. We'd be running cash flow negative for a little while, but then massive jump in revenue off the back of it, but this sort of time in the middle. So we're seeing a lot of that, which is, we sell devices to enterprise or around the world. They really want to do it, but I'm looking at my manufacturing costs and the time of that, and then the revenue turning on and going, there's a big fat hole here. I don't want to sell shares to fund it because selling shares before the revenue is extremely expensive, right?
Yep.
You want to sell them after, if at all.
Yes.
So we're able to sort of help and get in there, and that requires a deep understanding of the business, which we love to do.
And the customers, they're coming out of the woodwork, are they? So they're breaking away from established relationships or established brands?
Some are. I would say the vast majority of them have never borrowed money before because they haven't had the ability to. So it's actually more a little bit of sort of blue ocean than taking away from. There's been, in the last 12 months, there's been some overseas lenders like Wayfair and these e-commerce guys that have pulled out of the market. You may have read, they're just like, Australia, we're out.
Yep.
So there's definitely some of those facilities that we've gone and go, oh, well, we can do the same thing as them, or a slightly different offering, or a slightly better offering sometimes. And the customer's like, hey, this thing's about to roll off because they didn't make them pay it out. They just let them roll it out, and then can roll you guys in. So that's definitely been a conversation. The use cases for our money is generally, it's a bootstrap company, which means there's no external investors, just the founders, and they want to accelerate. They're an externally backed company from other people, but they don't need to raise any money because they're going very well, but they know that they can put money in the top and they will accelerate. So drop $1 in the top of their machine and $2 fall out the bottom. They can probably acquire customers via a channel, whether it be advertising or whatever. And quite often, there's some amazing VC-backed companies, those type that I mentioned, who have sold shares to those venture capital. They need to raise more money. They are raising more money. But right now, the prices of the shares are probably lower than they were before. So they're trying to sell fewer shares.
Yep.
And they use some of our money to counter selling as many shares and save dilution. So the founder, back to our original conversation, the founder will own more of their company because they sold fewer and use some of our money to bring the same amount of capital in to grow the company, but sell fewer shares in the meantime, therefore retain more of their own business as they scale up and save dilution.
This podcast is brought to you by Blenheim Partners, international board and executive search firm. Blenheim Partners guide and advise boards and executive teams on their most critical appointments.
You're not worried at all of all the sort of the chatter at the moment regarding the valuations of software companies? Last couple of nights, Google was in the press, obviously, in the last couple of days. There was a lot to drop off in terms of value.
Yeah.
There's been some other companies out there.
Tens of billions.
Yeah, hundreds of billions, I think it was, wasn't it?
Yeah.
Hundreds of billions.
Yeah,
So that's,
hundreds of billions. Yeah, it's insane. So luckily as a lender, the valuation of the company doesn't even come into play. Like, I don't care whether you're a $100 million company or a $0 million company, right? Like, it ultimately is like the diligence that my team does is very, and we have a whole origination platform that we use to analyze these businesses and pull in both quantitative and qualitative data to give them a risk score. We actually risk score and give a credit and risk score to every single company we talk to, which then use to determine the size and shape of whether we can, and then if we can, the size and shape of these loans. So the valuation of these companies is kind of neither here nor there as a lender.
Gotcha.
There is another side of our business where we're able to help them if they do want our help. We've got a side of the business that is focused on helping them grow their businesses and potentially raise capital. Where we do earn a little bit of, we earn the option to buy into the business. So we earn the option to buy, a couple of % of the business at today's fair market valuation. We're not asking, and that to your question is, we do have a conversation with them about trying to find a fair market valuation that we're all comfortable with. We don't want to come in at penny stocks and come in at a really low valuation. That's unfair for the founder. We want to come in at a fair market valuation, which today is probably less than it was 12 months ago, but it's still not crazy and it's not nothing.
So do you want to share to the audience some of the success stories you've seen in the last number of years?
Actually, just this week, I had an exit. It wasn't spectacular. I had an IRR of probably 5 or 6%, which is not what you want. You want an IRR of 40 or 50% when you get these things. But there's a company in my portfolio called BuildKite, and it's a very technical tool. Again, two mates of mine, software engineers, said, look, we've solved this problem that I use at work, and I want to go and sell it to other people. So back in the day, we did a very small round back in the day, which is a couple of $100,000. It wasn't a lot of money, but those guys actually took that money, and the promise that they said is like, we're going to grow fast, but we're not going to be on the traditional rocket path. By the time we spent this money, which is purely for our salaries, because they could do everything themselves, they didn't hire anyone else, we're going to make sure the company can pay for our salaries by the time we spent this money. So they did. So they got to the point where it was cash flow neutral, and then it started to grow, and they basically did 7.5% month-on-month growth for 75 months in a row.
That's pretty impressive.
At which point in time, we did one of those big secondary transactions and just went, you know what? We've built this amazing company. The team was much, much bigger than, of course. And every time the monthly recurring revenue went up $10,000, they went out and hired someone else, and then they sort of built the team behind the revenue. And that's just really unheard of, because usually it's like, give me $200,000. Cool. We spent the $200,000, but the revenue's only 10% of what we're spending every month. I need to go sell some more equity. They just didn't do that. They did a round earlier this year. They announced that with two local VCs, Airtree and One Ventures. And Michelle has taken a seat on their board, and they are on that trajectory now. They are on that fast growth trajectory. There's 100 people on the team. They do tens of millions of dollars a year in revenue. And in 2014, when we backed them, it was two blokes with zero revenue. So that's like that to me. That's the epitome of an interesting sort of middle ground. So it's not the traditional venture story where it's sell some equity, raise some money, spend the money, keep doing that because the revenue's nowhere near what we need to pay all these people.
Yep.
They sort of went the middle ground, which is, we sold a little bit of the company. It wasn't a lot. It was actually less than 10%. So I didn't do a big one, but the trajectory is real. Like, that is a massive company, and the clients they have are global. There's logos in there would melt your mind who use this software. That really is an amazing story that has some of their clients pay them over $1 million a year per client, because they've got big engineering teams that use it. So that's an amazing story. It went from closely held, I think there was only 9 of us that put that original money in, and then off it went. So that's an exciting story.
Just out of interest then, based on your experience, what was your gut instinct when you put the money in? This is going to make it? Or I'm still rolling the dice. Like, what did you feel?
There was definitely, I'm still rolling the dice. So I knew the founders well. Like, they were my mates.
Yeah.
One of them.
But that's sometimes even worse too, isn't it?
Yeah, sometimes. So there is a lot of people that say, like, I'd never invest in my mates. I'm like, okay, so on the assumption that the money I'm putting in is disposable.
Yeah,
You know, and it's not, you know, if I don't, it's not like I can't feed the kids because I've made this investment. That's not the case, right? So it's an investment, which is a high risk investment. What I did know, because I was also, as we said, a software developer before, is like the way you're solving this particular problem, which is a global problem, is unique. And I think you've got something special there. And it turns out they had. It turns out they got a lot of traction very early and was able to retain a lot of those customers for a long, long time.
How do they get the traction? That's what fascinates me. So they've gone from being nobody's heard of them to global clients, you're saying, spending over $1 million plus a year.
Yep.
All right, and building. How do they get the clients? And the second part to my question, why did those clients leave their existing relationships to come and join these guys, build it out of a garage or whatever the case is?
Exactly. Really good question. So a lot of the initial clients were Melbourne-based scale-ups. One of them worked at Envato, which is a privately held company that does a couple of $100 million a year in revenue. Other one worked at a company called Pin Payments, which is a payment gateway here out of Perth and Melbourne.
Yep.
So we'd been involved in the community of technologists in Melbourne. So the Ruby on Rails community, which is an open source program language back in the day, it's still there. You know, our mates all worked at realestate.com.au, which is a big customer to start with. Their old jobs became customers. Our mates tried it, used it, and still use it. And then the thing about these, which is called dev tools, so tools for developers, is devs change jobs and take them with them. So what will happen is you'll see one customer sort of drop down one user here, and then they'll pop up at this other user and you get this whole new account because they're like, at my last job, we solved that problem this way and it was amazing. I've walked into this new job. It's a bit of a shit show. Let me fix it for you. I've got a solution over here, and you get a new customer that way. And it turns out the devs move around the world. So quite often you'll see them pop up at some SaaS company in Europe. Like, where the hell did they come? Oh, that guy used to work over there. I remember that guy. And that's kind of what happened. Just kicked up the whole thing.
How many of them, from your experience again, are actually cut it as CEOs? You know, they might be brilliant dev, great visionaries. That's terrific, but execution's everything, isn't it?
Execution's everything, and people are everything as well, right? Look, I would say that there's the transition from nerd to founder to CEO is a janky one for everybody. I don't think I could point to anyone who's done it well, who did not feel like they were an absolute failure along the way, who is not feeling imposter syndrome, who wasn't like, what the hell am I doing? And some don't make it. It's kind of frowned upon in technology to sort of hand the reins over to a adult supervision and grey head CEO. A lot of these investors are definitely backing the founder to take it as far as they possibly can.
Drinking the Kool-Aid, yeah.
Yeah. You know, it's very much a we want you, you know, especially in the early days, right? It's like, I think you can solve this problem. Whether you can lead the team forever is anyone's guess.
So is this the Steve Jobs hangover?
Yeah, brilliant jerks don't go very, they kind of do and then they don't. You know, they get fired quite often. I've had a few mates that have been founders that have been fired, usually by their VCs, because, you know, they're probably less commercial than they need to be at that stage. You know, by the time you've taken that rocket fuel, if the rocket's not firing up, like, you're going to get some pressure to change stuff. And quite often it's like, well, change me. I'll go back and be the CTO, or I'll go find another what to do. And that's really confronting for everybody. But that's just par for the course, right? Like, you got to, by the time you've got other people's money, OPM, you know, especially that VC money, it's got high expectations attached to it. You can't dick about. Like, it's go time.
Okay, so just say flip it back the other way. I am on the rocket, or I'm on the tractor, whatever which way we're going to go, but I'm getting growth. And I'm the visionary, I'm the founder, I'm now the CEO, and I'm growing this business exceptionally well. How much time am I actually spending on the future? Or is it just, as you say, admin, looking after people, putting out fires? Am I really doing what should be done? Has it been carved out enough to let me do what I'm really good at?
It's fascinating, right? Because a lot of those founders are like problem-solving technologists. Their happy place is probably writing some code. You know, it might be a while ago since they did that. You know, that company that I mentioned, you know, my example I gave you there, that founding CTO has gone through all the positions that he's back at CEO. But even just the other day, tweeted out, like, I'm still helping on product. You know, he still sort of comes back to the team and go, like, this is what I think we should do, and gets down in the weeds, and we'll tinker on the weekends, right? Like, I don't think he's writing code that's going to production anymore. Like, it's not making the final product, but, you know, cracking hard problems. in prototyping and figuring out and then giving it to the team and go, hey, listen, I think this could be the start of something new. Why don't you sort of go out and flesh it out? Flesh out could happen often. I mean, I know as the CEO of Tractor where I was a technologist. I'm not writing code here. I've got a product and engineering team to do that. But, my job is definitely make sure I don't run out of money. And once you've raised money from other people and you're not profitable, you've kind of got one job, which is make sure we don't run out of money. So raising capital, especially in the current environment, is not a fast process. It's not a fun process. And it's basically a full-time job.
How do they lead compared to, conventional leadership?
I think it's probably a little bit more directly, probably more likely to be a little more pragmatic, maybe a little bit more product focused, a little, rather than maybe, at a higher level, just abstract, like they're used to quite often typing code and turning ideas into software.
So it's tangible.
Yeah, tangible. The irony is it's very tangible when you're clicking around on your phone or on your computer or whatever.
Yep.
But the banks still don't like it, right? It's still not tangible, right? Like it's something, obviously it's solving a problem, but it's not a real thing. So so it's a fascinating thing of leadership. A few days ago, I did a poll of like, is it risky for a founder to hang on too long or delegate too early?
Yeah,
and my gut feeling is hanging on too long is usually a governor to growth, right? If you're the founder who needs to have their finger in every single pie, that can't trust their people to get the job done, that's likely to slow growth down quicker than the opposite. Although, arguably, you hand stuff over too early and your kind of drive and your product stuff or any parts of that probably dilutes a little bit too quickly, right? And you're a little bit too far away from the problem because you're way up here and the problem's way down there, and maybe those people aren't building the exact quality of product that you are or that you used to. So, there's no right answer there. But I think if I was to say, if one was 49%, one was 51%, I'd suggest that hanging on too long probably governs growth. So the ability to delegate well is a fascinating skill which most don't have. It's just a thing that lots of people don't have by default.
And why do I want to join these people?
A lot of the time, the people that join them also understand the problem, identify with the problem. I am potentially a user, or I'm in the same market segment that this problem talks to. I've experienced it. A lot of people like chaos, right? Early stage startups are chaotic as hell. And a lot of people also want it for the potential financial upside, right? So a lot of these employees are shareholders, are gifted options at a very, very low price. So, when they do eventually get to the end, hopefully there is a financial transaction. Although I think a lot of that is sort of secondary to, I can come here and actually make a big difference. So, at Amazon, when I left, there was 1 million employees at Amazon globally. Like, it's very hard to have an impact when you're the millionth employee. When you're the second employee or the first employee or a co-founder, it's like, I can impact everything, which is also as equally as scary as not impacting anything. But I think it is that cool. I can really move the needle here. I can really make an impact on this team and hopefully impact those customers.
And so, Matt, in general then, if I'm going to go down this path, I need to give equity out if I'm the founder?
It's fascinating. So I've built and exited several companies, and I certainly err on the side of generosity. So I'm the founder who I'm only good at two things. Two things I'm personally good at is selling the vision, talking about the vision, and raising capital. So in a lending company, which we have sales, we have credit and risk, we have technology, we have operations, we have compliance, we have all these things. And I'm like, I'm sure as hell can't do those things. And I need the heads of those divisions to be very incentivized to do the right thing and to be here long term. So from day one in this particular company, my leadership and founding team have owned a big chunk of the company. Staff own a lot of this company. Some founders go the other way, and it's like, nope. I'm only going to give it to very key people. Most people I know, most tech companies I know, give it to everybody, right? And usually it's not a lot. Usually it's usually end up talking about not how much of the company you own, but what value of the company you got. Here's $100,000 worth of shares, which is 0.00 something percent of the company. But if you 10x it, it'll be worth $1 million, right? And that's always the trajectory that the rockets are on. And the reason they do that is they may pay less than market rates and go, here's some equity for you, stick around and it vests over time. So as long as you stick around, it'll be yours. And hopefully that incentivizes you to do a good job and really focus on growing the business.
Say the rocket. Is the rocket built around the founder, that they've got the personality, the style, or the founders, so I need to be on the rocket? Or is it built around the idea and the technology, if we don't move fast on this, someone else is going to come in, steal our technology, do it at a better price, offshore or whatever it is? What's it actually built on? Because I don't want to be burning the midnight oil every night of the week necessarily. I know the money's there, terrific, but that tractor solution sounds pretty good.
Initially, it's always, the founder's passion and desire to solve that problem at scale and go fast, right? Like it's like we do need to go fast. It could be because it is a hot area and there's competition heating up, especially once you're VC funded. You're constantly looking at the competition to go, geez, they've just raised X, tens of hundreds of $1 million at Y valuation. They're just going to outspend us. And, a lot of the time, that money these aren't necessarily very efficient businesses at this point in time, because they just use the money to hire a ton of people to solve, like they brush over inefficiencies by just hiring heaps and heaps of people, which unfortunately then increases their fixed costs, which then means they've got to pay for that every month, and that gets expensive. A lot of these people are on a big mission. A lot of these people, like one of the missions of the companies I invested in was something along the lines of they have a platform that plugs into a piece of medical hardware to help eradicate the world of disease. Like that is their mission. Their mission is like, if we can get our software into more of these hardware devices, which allows more scientists to do their work, close that loop quicker, there'll be more disease eradicated because better drugs are made faster, right? Like when you say that, like I just got goosebumps saying it out loud. Like you're like, cool. And, I can get behind these people. And you know what? Going slow there is a bad idea, right? They've got to go fast, really. Where another example I give is one of our early tractor portfolio companies. They were a SaaS company that ran in your web browser, and they ran a booking system for martial arts studios, and are really good at letting the students book in and do the grading for their belts, the karate belts, green belt, black belt, whatever. And and it was run by two blokes, cousins, and they had customers from 140 countries around the world. And they just potted along and slowly built the thing up, right? They're not out to help eradicate the world of disease. They're out to help, people running small businesses run their karate classes better, right? So you can see that those two businesses sort of run on a different cadence. And the martial arts guys are probably not going to be able to promise anybody they can 100x their returns on the capital they put in. So they were easily able to service our loan, because they just sort of slowly went up at a couple of percent every month, and their overheads were low. They were a designer and a developer, so they were able to do everything themselves. They didn't need a cast of thousands. They were pretty good at digital marketing, so they were able to get their Facebook ads working nicely. That's that business, right? Still got, to be clear, millions of dollars a year revenue, handful of people. Whereas the other platform I mentioned that is, trying to help eradicate the world of disease, like it's deep technology, right? You need a bunch of big brains that are expensive on that thing. But when they get it right, every scientist in the world can use this platform to do their job better. It's heavily capitalized. You've got to sell that really big vision. And then you've probably got to capitalize it well to get there, because you can't potter around on your way to that vision. It's too expensive.
So how long are we going to stay in Australia for? If I've got that group and I've come and seen you and you helped me out, I'm doing a good job, took your advice, I went the rocket as opposed to the tractor, or even tractor, I've done well.
Yep.
But I've got this big vision, as you say, or big mission, as you say.
Yep.
Is that mission going to leave me sitting here in Australia, or is technology now that I don't have to be offshore?
You definitely don't have to be offshore. A lot of the big companies that are heavily VC backed have their developer presence here in Australia. Like if they're Australian domiciled, they started here. They might have sales teams and support teams where the customers are, but the software is built out of here. Mostly because the Australian government's very generous with their R&D tax grants. You basically get 50%, it varies, but 50% of the money you spend back in cash to reinvest back into your technology. And that's handy. When you're paying your devs $100,000 to $200,000 like each, any money back that you can plow back into their salary next year is really handy. And some of these, so you can build a really big Australian company. So you think about things like realestate.com.au, car sales, domain, the things that are physically constrained to a country that don't really make sense where what they do to grow is they buy the things that are just like them in another country, and they sort of become a bit of a holding company for these things. So in reality, even a lot of my tractors have international customers. Most of them have companies around the world because if it runs in a web browser, it can kind of run for anybody that can read it. There is complications of building software for global companies, time zones, weird stuff like that, which introduces complexity. But once you got your head around that, the constraints of having customers from around the world is really, can you support them? Can you talk to them in the time zone? Are they going to get mad if they ping you at 4 a.m. and you're not replying? There is actually some costs involved in doing that.
So don't judge a book by its cover then?
No, don't do that.
So what's really surprised you? Any interesting stories really blown you away?
Every now and then you see these founders that are like, the surprising ones are the things you think are like so niche. What the hell? Like, I didn't even know that existed. And then next thing you know, they've got, they're big. One of the ones in the tractor portfolio who's made software that monitors outdoor signs. Traditionally, they used to be offline. There'd be a big billboard by the side of the freeway and they'd go and change it once a month. The advertiser would buy a month worth. But now they're all digital and they're flicking all the time. They flick every 6 seconds or 10 seconds. And all of a sudden, the people who are buying that ad space are like, did my ad run where I thought it was going to run? Did I get all the eyeballs I thought I was going to get? And, you can't mark your own homework. So he's built a software platform to do that globally, right? It's all over the place. I just came back from a month in the States and they are lagging. They've got lots of offline billboards still. So the growth opportunities are massive, although he's mostly up in Asia. But things like that is like, did you know that there's a software platform written on Amazon Cloud that monitors how often the ads change on things? Like nobody thinks about that. You've never thought about that in your life until I just told you, right? Like it's weird, obscure shit that you don't think about, which turns out to be a massive company with millions of dollars of revenue and growing 100% year on year and blah, blah, blah. So like those are the founders that fascinate me. I know a lot about this really weird problem. I'm going to go and solve it. And they tell you about it. It's like, I've never had that thought before in my life. Never once has that crossed my mind.
Is that the diamond today? Niche versus general?
When you're thinking about technology companies, we talk about like this TAM, this total addressable market. Like how many customers is there for that thing? So, you ask me, hey, thinking about Tractor again, like those tech companies that are not risky enough for venture, but too risky for banks. How many of those? Yeah. You know what my answer is? I don't fucking know. Lots. But lots is enough, right? But a lot of them are like, how many billboards are there to manage? You're like, probably hundreds of millions globally. Like, wow. And it's niche in the fact that the people who run these businesses have got this sort of pointy end of a wedge insight into a problem that is probably actually global, but, they've started really small. So a lot of these B2B software, especially where it's like, how many customers are there for that thing? You're like, well, I don't really know, but I'm just going to start solving this problem. See how we go. Then you think about someone like a Canva. Mm-hmm. I'm sure we've all had a tinker in a web browser and played with Canva and busted out a funny graphic or something. Like the answer is everybody. Anyone on the computer is a customer. And you're like, wow, that's a lot of customers. But I think the niche things is you can also charge more quite often, right? If you go off and solve a very specific problem, you can go in and say, look, I know exactly if you use my software, you will know you're spending 3 hours less a day doing that boring thing you do. I'm going to charge you $100. And they go, yeah, that's fair. That kind of thing where the niche it is, the more likely you are to deeply understand, the more likely you are to be able to charge for it because it's going to be materially impactful to the user, even though there may not be many of them to start with. Where, Canva is like, cool, you can do your thing for free. And if you use that particular graphic, I'll charge you $1.
A couple of things here. So you mentioned Canva and others like that, right? How important then early stage is to get brand? Because let's say there was another company which is very similar to Canva, which turned up 8 months, 9 months later, had more funding, had bigger backers, came in a better way. How important is it for me to get brand? That I go, no, go Canva. That's the way to go.
Yeah, so maybe a slight rephrasing of the question is distribution via social proof, which is what the brand is really good for, right? So, I can answer here with my Tractor hat on, which is it's a stupid brand. Like what Tractor Ventures, I keep getting ads on my Instagram for agricultural things, and I get all this spam for agricultural things. Right. Nobody knows what the hell we do. But I guarantee you that if you asked any tech founder in Australia, like who's the best one to do revenue-based financing, there'll be one answer, and it's us, right? So I think brand is really important.
Is that because it was first in and then built?
We weren't necessarily first in. We were pretty early, but we weren't first. But it's certainly a brand that sticks, right? It's memorable. You may not know why it's memorable and it's a bit silly and it feels like an outlier, but it works. Also, I think brand is such a broad statement nowadays, right? So is it, the name, the way it looks, what it does? I think the product you sell needs to be good. Eventually it needs to be the best, but brand probably can quite often trump product, especially if it's if there is a lot of velocity behind it, because you can sort of catch the product up. But I mean, a lot of people would go the opposite and say, the product needs to be amazing and the brand we can muck around with later. So I do think distribution is the interesting one. The adage in startup land is something like, success, startup needs to get traction before the incumbent gets distributed, or something like that. Or it's like they need to get big enough before the big guys go, hang on a minute, there's something interesting over there, and they just point the fire hose at it, right?
Yeah, exactly right.
So that's always something you're thinking about when you're building your tech company.
And that's traction under the radar as well, right?
Yeah, a lot of the time, I don't recommend anybody doing anything in stealth, like, doing it and being protective of stuff, because I personally believe the more people who know about your stuff, the more likely you are to be able to get some inputs back, whether they be positive or negative. But doing everything in stealth, behind doors, in closed things, it's a real inhibitor to getting that customer feedback a lot of the time, or even market feedback. And you might think you're building the best product on earth, but could it be better if you told more people about it?
I know, but that sort of flies into the face of what we learned many years ago. I'm sharing my IP. I'm sharing my ideas. That's what someone else could trump me on that, or someone else could just take that little bit and run of it better than I could. Yeah,
so like the assumption there is that there's somebody out there doing something very similar. They've got the same degree of understanding you do. And brand is hard to copy, right? Like it's very difficult to copy the, for lack of a better term, the vibe, like the people, the voice, the whatever. Like, I know that our competition, watch what we do, and they subscribe to our newsletter and so on and so forth. And that's just the way it happens, right? Like, there's nothing you can do about that. And one thing at Amazon, takeaway for Amazon is, they are customer obsessed. They're like, we talk to our customers, we listen to our customers, we build for our customers, we really ignore what's going on in competition. And the reason being is, if someone's copying you, they're never going to get ahead of you, because they're always catching up. And Amazon's thesis was, if we listen to our customers and give them what they want, and some of the things they want are never going to change. They're never going to want higher prices with fewer choice. Some of these really fundamental things. We do that for them, we'll be fine. And it was the least competition-obsessed company I've ever seen. They just, mostly because they were generally, the competition were also rants as well, right? Like they couldn't cut it with versus AWS. They couldn't cut it versus Amazon.com. They just didn't care. But really, it was just like, how do we give the things to our customers really, really quickly and listen to what they want?
You're listening to No Limitations with special guest Matt Allen. In our next episode, I sit down with Ian Bailey, Managing Director of Kmart Group.
I definitely think you've got to find people with the right aptitude. So I love people who are humble. I think ego is a real problem. If you're looking at team-based environments, and something like a retail is so team-based, because you need combinations of people to work together to get outcomes. So people who are humble, really important. People who are willing to get right in, get their hands dirty, really important. They've got to want to learn. Yeah, and then occasionally you need technical expertise. It sort of helps if you're running supply chain that you know what distribution centers are. So there's times you need some technical expertise as well because of the nature of the role. But we generally I'd prioritise the attributes and the core capabilities as long as the technical pieces are adequate.
Be sure to join us on our next episode. And now, back to the show. So when you walked into that, okay, admittedly there was two of you started up and you built it, but what was the culture set out to be? You've been advising a lot of startups, you've been advising technology companies, and suddenly this big,
big behemoth,
US giant, comes in.
So lucky for me, my boss Ian and I are good mates. We're also pretty loose. So, and the job was like we were reported to Seattle via APAC in Singapore, down in the little old Melbourne, and he was my boss in Sydney. So like 4 levels of removal. And really, when I was hired, they're like, listen, we don't have too many structured goals right now. What I want you to do is just go out and listen to founders and help them. Like, go find out what you can do to help them. Use Amazon, use the brand, use the leverage, use the other people inside Amazon to help these founders build a better business on top of our cloud, which means they'll use more cloud and everyone's happy, right? It's a bit of a self-fulfilling prophecy there. They worked well for a long time. Towards the end, 2.5 years later, there was definitely more constraints and rules. And here's the 15 goals we'd like you to do. And I'm like, 13 of those are stupid. I'm not going to do them. And they're like, well, you probably should. And I'm like, I think I'm done here. So it was probably through a growth phase in our little patch of the business that was being very impactful without too many constraints at that particular point in time. So, and I know that, they have these Amazon leadership principles that they live and die by these things. There's 14 of them. It starts with customer obsession and to deliver results. And I think there's 12 others in between. And they were used every day in conversation. And the times at Amazon when I never got in trouble where I was questioned was when I wasn't doing something. I never got questioned for doing something. I always why haven't you done it? Just do it. We hired people. Bar is really high for hiring. Once you're in, they kind of get out of your way. And it's up to you to just go get stuff done. One of those principles is are right a lot. We hire people who are right a lot. Their gut instinct tells them what to do and they just do it. And most of the time they're right. And, another one was bias for action. We want you to do stuff. Don't sit around waiting. We're not here. You don't need consensus. You just got to get some stuff done. So those two things combined allowed me to do some stuff that, I didn't really need to ask permission to. I just got on with it. And it was generally helpful for customers and things like that. So the culture in there was definitely that bias for action was a thing. There was very much no one's going to tell you what to do. If you think it's the right thing to do, just go and do it. And that was pretty liberating for me, being a founder. My job is just to solve problems. And I'd walk in, I'm like, hey, there's something over here I need to do. I just go and do it. They had decent budget, a fair bit of rope, tried not to hang myself too often.
Do you find that same autonomy in the startups you're investing in now or similar?
Yeah, especially when you're building things that don't exist, right? When most of these people are forging ahead and having to back themselves to take risks. A lot of people will tell you that founders are super risky. I don't think they are. I think they're taking very calculated risks, right? When you, especially in a capital constrained environment, you don't have tons of profits to go and drive back in. You really got to choose where your energy and your dollars go. So, most of the founders I know, especially the tractor ones, are even better at being efficient with their capital, right? If you just raise $50 million from a VC to sit in a bank account, the likelihood of you not hiring people is low. You're going to hire a bunch of people and hope like hell they work out. If you sit and look at your bank account and it's plus minus whatever on a monthly basis, and the revenue from last month has to pay for this month, you're far more particular about what you do. But none of these founders like being told what to do. That is a trait that you will definitely find. And the ones who don't have that bias for action and don't kind of back themselves are the ones that quite often sort of you can what if yourself into the ground as a founder, right? Because you have to work with patchy information and sometimes no information. You got to just sort of take that next step.
So what are they running on? Just sheer instinct?
A lot of time. A lot of them can be data-driven eventually. You have customer behavior and you have customers who are using it, who are moaning about certain things or asking for certain things, and you sort of start to think. But initially, a lot of the time, it's I think this might work. You can go and research it. You can run cheap experiments of putting stuff in front of people and seeing whether they get through to click the buy button and whether or not they fill their credit card in, even if haven't hooked the credit card up yet. There's ways to run experiments as to try and understand people's behavior and understand whether they want to buy the thing you've got. But eventually you've got to build something and sort of get it out there. And then a lot of the time, the best ones are around really taking that feedback and iterating on the solution, to continually try and solve that problem we spoke to earlier, because the problem is probably relatively static. It might change a little bit over time, but it really is sort of taking any data you've got to build a better product.
If they walked into a room right now, are they knocking me over with confidence? So have they got the X factor, or have they just got that inner confidence? I'm going to back myself. I know what I'm doing. But I'm sure there's no one rule, of course. But what do you see?
It depends which country you're in. So in America, they're all amazing salespeople. They'll all tell you that they're the next big thing. They're the next Google. You should definitely invest in my company. We are doing this. We're crushing it. We're killing it. It's amazing. In Australia, I think we are more reserved by default. I think our friends... generally socially, that tall poppy thing will take you down a peg if you're too confident. And the best way I can describe this to you is we've all seen the startup pitch decks that have got sort of, and this is what we're going to do over the next 3 years or next 5 years worth of growth. That exact same slide will make Australian investors will go, oof, that's pretty ballsy. You sure you can do it? And the exact same side in America would be like, the last guy said he was going to do 10x that. You're obviously shit because he said he was going to do 10. I'm not going to invest in you, because the competition for investment money is really like the last bloke that came through who told him we're going to do this amazing thing, and you're fighting for other investments. You know what I mean? Like other founders are all vying for the same dollar. So over in the States, we quite often get, told we need to amp it up and dial up that ambition and really do that. And I also think even in Australia, we need to amp it up a little bit, even if your mates at the pub will give you shit about it. Confidence and the ability to go, I don't actually know, but if we get this right, this is how big it can be. And the question a lot of the VCs ask is like, how big could this be? Not like, what's the likelihood of you doing it? It's how big could it be? And those two things sort of push and pull against each other, because you can't have a zero likelihood and, even 100% likelihood of a $2 million a year company. The VCs can't fuel that rocket up because the rocket's too small, right? That's a tiny little firecracker. They want an Elon-style rocket, right? Could be good for a tractor. It could be great. But in that particular funding model, you've got a small probability of a disproportionately large return. So coming back to your question, what are these founders like? Those founders are absolutely driven on the thing they're going to do. They may present super confidently. They may be super meek and mild, but I would suggest that more on the top 50th percentile of confidence rather than the lower 50th.
Are they ruthless?
Some are, yeah, especially in the early days. You can't afford that. There's very few passengers. You don't have time for passengers. Most founders I know are actually quite kind, but pretty precise, like pretty trying to, like, given your resource constraint, everyone's got to be on the bus and pulling in the same direction. It's really, dealing with people that aren't all in is terribly distracting.
Yeah. What's the do's and don'ts? What's the good advice? What's the bad advice?
As an investor, a lot of founders will show you an amazing deck which talks about how brilliant they're going to be, but the ability to execute on that, you can take certain risks. You can take a risk on the market. You can take a risk on the execution. You can take a risk on the founders. I'd strongly recommend not taking a risk on the founders early days if you're investing, try and really spend some time with them. I've always said, for me, there's some arbitrary trust threshold when I'm talking to founders, and then they'll cross it and I'm in, right? And then, so as an investor, recommendation if you're doing early investing is pick a check size. Doesn't have to be big, and just stick to it. Say, I do 10 grand checks, or I do 50 grand checks, or whatever. That's all I do. So that takes that decision point out. It's like, this is what I do. Just try and stick to my own knitting. As a founder, when you're off talking to people and if you're trying to raise capital to get your company going, most investors are really dumb. I am. I know about what I know, but I know about what you know. And excitement is inversely correlated to how little I know. If I don't know a lot, I might get really excited about something. And then the person who knows a lot about it was like, I'm not going to invest in those guys. They're morons, right? So those two things create a whole bunch of weird feedback loops when you're off raising, because you're pitching your new thing, especially if it's domain specific or scientific or something where it's like this is not simple. This is not Instagram for cats. This is curing cancer. So my advice to founders is, if your early backers understand the problem, so you don't have to explain the problem to them, you're more likely to get good input, right? So, if those founders who are building software technology to take data out of a very scientific machine, and they're like, so the problem is the data that comes out of this machine is really hard to interpret, and there's only 1,000 people in the world that can do it, and we've automated that. If you walk into someone who knows how that machine works and suffers the problem, who is also hopefully able to invest because they're rich, I would have those conversations. If you could seek those people out, that's always better than trying to explain to random people about difficult problems and then explain to them, because, what success might look like.
Should I go into business with a good mate? Or more so, should I go into business with my partner like you are?
Yes, I've got two co-founders. One's my best friend and one's my wife. Wow. So I went into business with my wife after 20 years of marriage. We do work in different parts of the business. So we do have, she is very operational as a COO, and I'm one of the co-CEOs. I don't know. We have a disproportionately large number of life partners as founders at Tractor. And the reason being is because we're not VC and because we're not putting that pressure on the business to go really fast. If you've got, quite often, all these founders' eggs are in one basket, right? The only asset they've got is this business. So if you're a husband and wife team to then take capital that expects you to 300-400% year-on-year growth, and that's not what you're doing right now, and you both work in it, and it's more likely that you may not want to go down that path. And a lot of VCs won't back life partner people, but then again, Mel and Cliff from Canva, now married, were life partners. So for every counter, for everything that says don't back life partners, it's messy, there's but one of the most valuable software companies in the world is run by life partners. Don't back single founders because, you got no redundancy built in. Some of the biggest companies in the world, NASDAQ listed, were run by single founders. Like, there is no rhyme nor reason. Should you go with your mate? I mean, for me, I've done businesses with my mates before. It can be equally as good as it is bad.
Government.
Yep.
Are we building the platform or supporting enough this whole opportunity, as you say? They're building a wave of startup.
It's a polarizing discussion, the old government. So I sit on the investment committee of a thing called the Alice Anderson Fund here in Victoria. It's a $10 million Victorian government fund that invests in women-led startups. So for every $3 they raise from the public market, or from whoever, the private market, we'll put in $1. So we'll match it 3-1. And of that $1, 15% of it's a grant. So we only get 85 cents worth of shares for every $1 we put in. 50% is non-dilutive, which I think is really important. For the founders to get money from us as a government department, one of their investors needs to bring the investment to us. They need to show us all the diligence they've done. We look at it and go, this looks like a good deal. We'll put some money in. So we're very passive. We don't take board seats. We're none of that. We're just sort of matching what the market is suggesting, and we're making decisions based on the diligence and the quality of the deal. I like that. But a lot of people, there's a lot of founders, it's like, government, you do infrastructure, you make sure that we can get our R&D money really quickly, and it allows us to run our business. Open up the visas so we can get smart people from overseas, because there sure as hell isn't enough of them here. We need those people here to help us grow our businesses. Don't get in our way. Don't slow it down. Don't put undue burden on them or us to get the job done. Infrastructure things like in Sydney, there's a thing called the Startup Hub, which is above Wynyard Station, 4 or 5 floors. Like, that thing's a lightning rod. I can't walk through that place without seeing 10 people I know. Like, that's a really smart move to just get, the government can make serendipity easy by sort of putting a bit of a lightning rod on a location. Like, I think they did a good job. It's not the nicest building on earth, but, your startup founders, you're there to work hard, it doesn't have to look great. And they're doing Tech Central above Central Station as well, which I think will be the same thing in a modern environment. I really like that as a way that government can help. Governments will do a lot of grants and stuff, but geez, the energy that founders put into grants are almost the same energy they use to raising capital. Surely they're not selling shares for it, but they're not free. They're definitely not free, that's for sure. So, I'd love to see some more grants that are easier to attain. But, I guess they've got to counter the people taking the piss as well. So, that's a bit of a balance in there. So I think our government does a reasonable, good job. I mean, that R&D tax incentive is real. Like, I know people that have absolutely, spent tens of millions on their developers, but also pulled tens of millions of dollars back into their business and reinvested it. And without it, they wouldn't be here. So, that is a scheme that I think is really amazing.
What's the stats on failure?
So there's a lot of data on venture-backed failure because, like we mentioned earlier, they run portfolio theory. They're okay for a whole bunch of them to fail. There's outright failure, bankrupt, gone, shares to zero, founders packed up, went home. There's failure as through the lens of the financial vehicle. So, failure from VCs, like, I put in $1 and 3 or 4 years later, they shut it down, I got $1 back. It's like, that's stupid. I got to give it back to my investors, and they didn't want $1 back. They want 10 back, What we're seeing in the Tractor side of things is part of the hypothesis I had on that asset class that I described is the DNA of these founders. They don't fail. They're more capital efficient. They don't fly super close to the sun. They don't run their bank accounts empty. They kind of have got buffers built into things. We're seeing, we haven't seen any failures we haven't even seen a loan fail after 90. We have no impaired loans right now, which is kind of bonkers to think that 2 years down the track. And next month, our very first loan has done its full arc and paid all the way back. A whole bunch of them are refinanced and got more money in, but one that's gone from beginning, middle, end is done, come and gone. Good. It's amazing. That company is probably, I imagine they've tripled their revenue in maybe doubled in 2 years off the back of that capital, has allowed them to invest in some things, and off they go. So I think failure is quite often a function of the expectation of the capital that's gone into the business. So as a founder, you need to be very acutely aware of the expectations of, if you're going to take money from other people, like they can quite often not force failure, but definitely make it so that it's very hard for you to continue working, continue growing. So the thing about venture-backed companies is that most don't fail because they can't raise money. They fail because they can't raise more money, right? So you've raised all this money for people like me, and you're like, hey, this is going to be great, let's go. And then you do it and it doesn't quite hit the mark because you haven't hit that product market fit, whatever reason. And they're like, hey, we need some more money because we've hired 15 people and it costs us $50,000 a month to run this thing. And everyone's like, like it was great. So when you're raising money, the company needs to be one of two sort of absolute states, which is an amazing story and no numbers, so everyone just believes the story, or an amazing story and amazing numbers, where the numbers can sort of get your capital coming back in like, well, that's going, we're going to keep going. The challenge is amazing numbers is a massive range depending on who you're talking to and who you get your capital from. So I think those are the things that I really think about, when it comes to what success and failure looks like, is choose wisely who you get your capital from and how they expect it to be returned to them. Because if you need more of it, and your shareholders are grumpy or you haven't hit your numbers, it's going to be real hard for you, and that might force your hand. You might have to shut it down.
Are the banks ever going to change?
I don't know. So I've recently just pulled in my first non-exec director. So all our directors are exec, and he works on a big ASX listed company. He's like, what do you want to do this thing? You want to be a bank? I suggest you don't do that. And the problem we have with Australian banks especially is, they're heavily governed, which is fine and makes them really resilient businesses. Their shareholders love their dividends, right? Which means they're obviously extremely profitable. They're profitable probably because the asset classes they back, especially at scale, are dependable and are even less risky than our less risky startups. And I think their appetite for risk, and I think, in general, Australian banks' appetite for risk is very, very low. Very low. They're happy to do your mortgage-backed securities all day long. They'll lend you some money secured against something that they know they can get it back and do a low LVR. So, even a fire sale to get money back. But progress is quite often a factor of risk-taking. So, I think that their ability to take people's money, especially once you're an authorized deposit taker, like balancing risk there is just what they have to do. So to answer your question, will they ever change? I hope not, because it allows me to grow a really big business and service a bunch of customers that they just don't understand and may not ever understand.
So without you being Rocket, although you do hedge yourself, because I think you are involved in Rocket still a little bit, aren't you?
Yeah, and the irony is Tractor itself quadrupled in everything that we measure last year. So I've got
pretty fast Tractor.
I've got a few venture capitalists who invest in Tractor because we have shareholders on personal account, not from their company, who is like, if you were in my portfolio, you'd be at the top of it. Like you guys are going really quickly. And it's not because, so that's an interesting, angle there as well, is the capital doesn't make you go fast. The customers make you go fast. If you can find that product market fit and you get pulled along, that's what will make you go fast. And if you can do that in a capital efficient way and not have to raise a ton of money, you've probably got a start of a really good business, which may go as fast as a rocket, where you don't actually have to fuel it up. We've raised a bunch of money from our shareholders, but they're all individuals and family offices who expectations are not the same as if they'd love it if they got those returns, but that's not necessarily why they're here. So yeah, going fast is a function of how well your product matches the market demand for it.
All right. So if you rolled into a family office tomorrow and I say, that's terrific, I looked at it, it's great returns here, Matt. Where are you going to be in 5 years' time? So what is the big plan?
We'd love to have $1 billion of funds under management. And I think half of it will be in the lending side of our business. And we'll actually start up a fund that's not dissimilar to a venture fund. We will buy equity in Tractors. So the companies that are not VC compatible because they're growing nice and consistently, there's still a problem to solve over there with equity, which is the founders running these businesses doing millions and millions of years in revenue. Yep. It's difficult for them to realize some of the asset they've built. So we'll actually go and buy some of their company off them, continue to let them do what they want to do. They can take some of that money as primary onto the balance sheet so they can grow a bit faster. Some of it they can take off and go buy a house. I have a very, very strong opinion that a de-risked founder personally runs a better business, full stop. If you own your house, you can run a way better business than if you're stressed out that if this business fails, I've got nowhere to live or I'm, heavily mortgaged. So that product will help founders, take enough of the asset off the table to allow them to go and probably either buy a house or buy their first house, maybe not the big one on the beaches in Sydney, but certainly enough of them to go, great, now I know that I can really focus on this business and build it. And what I've seen, and I personally had this thing, is when I did all those secondaries and paid my mortgage off, my ability to start Tractor went up infinitely because I didn't have to worry about, my current state. So that is the big long-term Tractor. We'll have $1 billion of funds under management. We'll have an equity fund that helps Tractor founders do what they want to do, and the debt fund that helps them use that to grow their business as well.
So what actually is business to you then? Is it just art in a different form that you create?
That's an amazing question. Look, I think it's people. I genuinely believe the people surround yourself with can make or break. If you get up and go to work and you're like, I love my people. And the corollary to that, the opposite of that is people are a giant pain in the ass. I actually want fewer of them around me rather than I don't want a cast of thousands, because I think the speed of your business growth and headcount are uncorrelated. You don't double your size and go twice as fast. It just doesn't work that way. So I think headcount is an awful measure. Efficiency and size are not correlated a lot of the time. So at Tractor, we're a very efficient team. One of our metrics we put in our shareholder update is revenue per employee. We're very focused on, and the whole team is incentivized to how do we run a better business, right? How do we actually, how do we make sure that when we do hire more people, it's for the right reasons rather than just because it's easier to hire someone, let them do that job. We use software, we use technology, we use automation to try and keep our real finger on our pulse to run a capital efficient business.
Last question. If you're going to look back at that young gentleman starting out as a tech developer all those years ago, bearing in mind where you're going to, what advice would you give him now?
Yeah, it's interesting. I spent the first 40 years of my life being told I need to be better at the things I'm bad at, and worrying about it. Being told to, look, you're good at this, but you're bad at that. You really should be better at that thing over there. And okay, well, let me go and try and fix that. And it was 40 years of pain. And then when I turned 40, I just realized that if I doubled down on the shit I was good at and then structured the things around me so that I didn't have to do the things I didn't like and hired people who love doing those things, it was the biggest unlock of my life. So if that guy said, look, you're probably going to have to do the dishes for a while, but eventually you're going to get good at some things, and trying to be this well-rounded generalist is probably a constraint rather than an accelerator. So, when I realized that I'm only good at a couple of things, and I think everybody's only good at one or two things. So when I hire my people, I'm like, tell me the two things you're good at. I'm a laundry list. I'm like, no, you're not. From 3 through to 15 is absolute diminishing returns. I don't want you to do any of that stuff. Just do the things you're good at. And then allowing people to do that. So my advice to young me is double down on the shit you love and you're good at and be okay with that. And when people say, hey, you should really be better at that detailed thing over there, tell them to go away.
On that, Matt, I've thoroughly enjoyed today. Thank you very much for making the time. It's been a great conversation.
That's my pleasure. Hopefully it's entertaining to your listeners. And if there's anything interesting here, I'm always happy to have a chat with people. And, funnily enough, the things I'm good at are talking about what we do and hopefully telling people why we do what we do. And that involves a whole bunch of stuff. So I try and run as empty a calendar as I possibly can so that when interesting people come along, we can help them out. And that requires lots of conversations. And that's what I do.
How do we contact you?
TractorVentures.com is us. My email is matt@TractorVentures.com. I tweet too much at Matt Allen, and that's probably the best place to find me.
On that, you've been listening to No Limitations.